Everybody, welcome. We're doing intermediate accounting, income taxes, and we're looking at here at some comprehensive problems. So my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or any affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright of those parties. So let's now go through and take a look at this additional problem, which should be additionally challenging, and let's have some fun. So we've got over here, LGA began operations in 2028. And during 2028, there was 1.2 million of pre-tax financial income. On January 1st, there was an asset purchase for $1 million. For financial statement purposes, the asset will be depreciated using straight line over 5 years, assume no salvage value and a full year of financial statement depreciation for year one. For tax purposes, the asset was fully depreciated in 2028. Fines non-deductible for tax purposes of $10,000 were deducted for computing pre-tax income in 2028. The tax rate for 2028 and future periods as of 12/31/28 is 25%. So let's do 2028 first. So here we've got, let's figure out where we are. So we've got basically my pre-tax, financial income was 1.2 million. And what I want to really try to do first is to say, what are the permanent differences? Okay, so what are the permanent differences? So the permanent difference over here is that the fines, which I deducted from here, I have to basically go through and add back. So basically over here, I'll call this financial statement income. And then basically my pre-tax, or my income as adjusted is going to be 1.2 million. Okay. Also, so we got over here now. With this asset, it was basically depreciated using straight line over 5 years. Well, if I take acquisition cost minus salvage value divided by the estimated useful life, or 1 million minus 0 divided by 5, this is going to be $200,000 per year. So if I look at this in 2028, right here, I only took basically a $200,000 deduction. But for tax purposes, I'm able to write off the entire thing. So for this, for all intents and purposes, right, what is my temporary difference? Well, my temporary difference is going to be 800,000. So with my temporary difference being 800,000, basically my taxable income is going to be $410,000. Okay, so again, key thing is here is with temporary differences, I'm allowed $1 million for depreciation for 2028. To get to this, I only took 200, so I'm going to get an additional $800,000 worth of depreciation. So now my taxable income is 410,000. So let's go over here now and kind of take a look at, let's move this down a little bit. We may want to use this again. Okay. So when it comes to doing my journal entry to record income tax, I'm going to have income tax expense. I'm going to have basically my income taxes payable, and then I'm going to have my deferred tax liability. And why is it a liability? Because eventually I'm going to have to pay tax on these amounts. I'm getting the benefit of it now, and then I'll basically be going through and paying later. Okay, so this is going to be record income tax expense. So here we basically have my income tax expense would essentially be 1,210,000 at 25% because that is what the tax rate was as of 12/31/28. Then over here, my income taxes payable are going to be 410,000 or 102,500, meaning that my difference here, my deferred tax liability, is going to be this 800,000 at 25%. And if we add these two up, this actually goes through and balances. So here for 2028, what I want to go ahead and do is just say I'm going to have here a deferred tax liability for the 20, we'll call this equipment 28. Okay, so this is going to be 200,000. Okay, so that's what my very first 2020, this is what 2028 looks like. Now let's look at 2029. So during 2029, there was 1.5 million in pre-tax financial income. On January 1st, we also purchased another asset for $500,000. For financial statement purposes, the asset will be depreciated over straight line over 4 years, assume no salvage value and a full year of financial statement depreciation for year one. For tax purposes, the asset was fully depreciated in 2029. We're also being told that the tax rate for 2029 was 25%. However, for future periods, beginning in 2030 and thereafter, the enacted rate will be 22%. So what I want to kind of do first is let's go through our same process. And with 2029, my financial statement income was 1.5 million. Okay, basically there was no permanent differences. However, one of the things that's happening is that, well, I was able to get this amount here, but this thing is actually going to be going through and reversing. And what do I mean by that? Well, you had 2028, 2029, 2030, 2031, and then 2032. And what we kind of saw here is that, well, for this asset from 2028, right, you basically had, as of the end of this, we had deferred taxes of 800,000. Where is that kind of coming from? So we had a deferred tax liability pre-tax of 800,000. So it's a pre-tax. That was basically what that liability was based on. However, when we look at this here, obviously after tax, we said that's going to be at the 25%. But what happens now is that I'm going to kind of have to kind of go through and pay the piper, right? Because my temporary difference for the 28 equipment, I'm now going to have to go through and pay basically 200 grand, basically because this is going to be this amount over here, or this part of the liability for 2029 is starting to go through and reverse. So what we kind of see is with this temporary difference is that I'm ultimately going to have to pay back this 800,000, but it's going to be over a period of 4 years. So basically you'd have 2029, 2030, 2031, and then 2032, right? We're going to have to go back over here and basically pay this back. This is how the 800,000 is going to go through and reverse over time. So that's what's happening kind of over here. So that's the first thing we have to kind of go through and figure out is what happened with the equipment from last year. Now let's take a look at the equipment from this year. So for the equipment for this year, for 2029, this is 500,000 and it's basically being purchased for 500, depreciated straight line over 4 years. So again, this is going to be 500,000 divided by 4. On 5, it's no salvage value. So this is going to be 125,000 per year. So here in 2029, and we'll call this a 29 asset, right, for 2029. And this was book tax. So for book purposes, I'm taking 125, I took 125,000. However, for tax purposes, I went through and took the full amount for 500,000. So there is now a difference here of 375,000. So this again is going to be a temporary difference. And we'll call this the 29 equipment of 375,000. Okay. So this is causing right over here, I'm able to deduct an additional 375,000, right? I took 125, I'm allowed to deduct the full thing. So it's an additional 375,000. So then my taxable income is going to be 1,325,000. So what I now want to go ahead and do is to kind of say, let's deal with the 2029 parts that we know first. So the first one is going to be income taxes payable, right? What is income taxes payable going to kind of go through and look like? Well, my income taxes payable is going to be my taxable income times 25%. Now, remember with this income tax is payable, right? For 2029, the tax rate was still 25%. So I want to keep on going and basically going through and using that. What I also know as well is that this here is going to be reversing, right? So this equipment over here is basically reversing. Now, this is a pre-tax number, but if I take the 200,000 times 25%, this is going to get me over here at basically is roughly at 150,000. Okay. So here I'm going to go ahead and say deferred tax liability equipment, my 28 equipment. This is going to be reversing at least this year by 50,000. How did I get the 50,000? It's this 200,000 here, which is the amount it's reversing, basically times the 25%. Okay, so my deferred tax liability account currently has 150,000. Now, what is this really coming from? Well, currently this is coming from the future tax periods, right? So this is what this kind of goes through, which looks like. However, when we take a look at this, well, is it really now 150,000? What is the proper amount going to basically go through and be? Well, if we're being told that the new tax rate over here is going to be 22%, then when it comes to these future amounts, then our liability as it relates to this part over here is going to be 132,000. Okay. So this part over here is going to be at 132,000. This is what the liability basically should go through and be for that 2028 equipment. Okay, and I'm keeping this separated for a very important reason. Okay, so for this part over here, what I'm going to go ahead and do is I'm just going to go ahead and basically book another $18,000 adjustment. Basically, we'll call this adjusting my deferred tax liability right over here. Okay, so deferred tax liability 28 equipment adjust, and we'll call this 18,000. Okay. So let's go through, and I know a lot of stuff is happening here, but let's go through and take a step back. Okay, our tax rate has gone through and has changed. What does that mean? Well, it's going to affect our liability because it went down, right? So for 2029, I basically reduced my deferred tax liability on the 28 equipment by $50,000 or $200,000 at 25%. Now, when it comes over here, I'm also going to need to basically make an additional adjustment. And why is that? Well, this 150,000 we kind of saw was effectively based on the old tax rate of 25% for the remaining periods, right? Because I basically, once this has been satisfied, my ending balance as of 12/31/29, this is pre-rate change, was 150. However, what I'm now going through and doing is saying, wait a second, the new tax rate is at 22%, right? So therefore, my liability needs to essentially, it's no longer going to be 150. It now needs to be 132. So what I need to do is to adjust my deferred tax liability right over here by the $18,000. Okay. Now let's go through and now take a look at the new equipment that we went through and purchased. So when this new equipment, and we'll call this the 29 asset. And remember, this was a 4-year, this was basically a 4-year asset. Okay, so for this is going to be 125,000, 125,000, 125,000. Remember, we've already dealt with the 125,000 here because we already took this amount for tax purposes. We took 500,000. So we have this remaining 375 that we're going to have to go through and pay. So my deferred tax liability for the 2029 equipment, right, is basically going to be, and this is pre-tax. Okay. So this over here is going to be 82,500. So this amount here, my ending balance in this account needs to be 82.5. How am I going to go through and get there? I'm going to go through over here and basically record this as 82,500. So my deferred tax liability on the 29 equipment is going to be here at 82,500. Okay, so again, I'm separating this out just so it's easier for you to follow along. Could you combine these? Yeah, don't have a problem with that. But again, it's something we want to kind of take into consideration. So now when we're going through, we'll have to kind of go, when we go through and talk about the income tax expense, that's something we'll have to go through and address, right? So, but we're not being asked to do that. We're just asked to do taxable income, not the disclosure. Okay, so now we have this over here. And why did I go through and do these things? Why did I do it this way? Well, my plug entry here is going to be income tax expense. And remember, as if rates change, I'm going to go through and basically make those adjustments accordingly to income tax expense. So here, my amount of my debits is 68,000. My amount of credits is 413,750. So my total amount of my income tax expense is going to be 345,750. Okay, so again, how did I get that value? I essentially went through and plugged it in. Okay, let me just make sure I do this. Okay, so just give me one moment and we will just want to verify this. Always fun too. And according to my artificial intelligence application, I think we're good to go. So in any event, hope you found this to be helpful. I look forward to seeing you on future videos. Have a great rest of your day. And thank you for liking and subscribing. If you have questions, please feel free to email me at ibc30tocpa@gmail.com. And I'll see you on the next video. Take care.